Hello and welcome to ICAEW Management Information. This is chapter number 1, and chapter number 1 gives us an introduction to everything which is management information, and it very specifically looks at fundamentals of costing. And what we're going to look at is what actually is cost accounting. We're going to have a look at cost accounting techniques, cost classification, and then the very tail end of this chapter we'll start having a look at ethics, because every single chapter has got an ethical impact. Every single paper will always have something to do with ethics within the exam somewhere, so make sure you're happy with that. Now what I'm going to do to start with is I'm going to give you a generic overview of how all these various different types of accountants fit together and where you're going to cover them within your exams. So we've got cost accountants, management accountants, we've got managers, we've got financial accountants, and then we've got auditors. The cost accountant is the accountant who collects data. The data will be collected usually from production activities, but it can be collected from anywhere. So the cost accountant collects data. Data is not useful to us. We can't do anything with data. So we can't make any type of decisions. We can't make any type of value from it. Data by itself is not particularly useful. That data is then given by the cost accountant to the management accountant. The management accountant will then process the data and turn it into information. That information is now useful information because that information can now be used for decision making. And then we move on to the manager. The manager will use that information that the management accountant has produced and he will make a decision. That decision will have an impact. That impact will be measured by the financial accountant. So that impact will be measured by the financial accountant. And then to give us additional comfort that the financial accountant has actually measured things correctly, we have the auditing process. Now this paper MI looks at the cost accountant and then the management accountant issues. We're looking about producing information for management so management can then make a decision. The idea of MI as a paper covers cost accounting and management accounting. When you then look at things such as BTF, you're looking at managers making decisions. When you're looking at the idea of the types of decisions that they could be making and their impact, you could have the principles of tax impact in here as well, and all the tax streams come in. Also, the financial management papers from year 2 onwards start to have an impact in here. And then the measurement of these things by the financial accountant is your accounting paper, your FAR, your CR, then also up to case. And then the auditing process is assurance, and then auditing and assurance, and then CR and a little bit into case as well. So everything fits into this very simple structure which allows everything to come together. You do not need to learn that. That's just a generic overview so you can see how everything fits together. This allows you to see why MI as a paper can be so important. Now the management information that we're producing is going to be used for decision making purposes. That now means that what we're looking to do is provide information to management so they can make decisions for the future. Now, if I'm looking at this from a financial accounting paper perspective, what I'd be looking at here is historic transactions. So historic transactions, and I'd be looking at historic recording of those transactions and then historic reporting on those transactions. That type of historic information is not useful for managers. What I'm looking for now is something which is much more up to date. Something which is potentially so up to date, it can predict what's going to happen in the future. And that's one of the things we do within the MI paper. We attempt to look at what's happened in the past with a view to predict what can happen in the future. So as we're going through this, every single chapter, think about why do management need that information? How can I use that information to derive better quality decisions? Better quality management decisions will always result in competitive advantage. This is why good quality management is so important. You can have the same data and the same information and you'll make completely the wrong decision. Good quality information allows for good quality decisions. It does not ensure good quality decisions because you can have poor management. Now, coming back into the real meat and bones of this chapter, what we've got is some key differences between management accounting and financial accounting. And you guys, I'm afraid, need to learn these parrot fashion. What we have with regard to financial accounting is specific legal reasons why you have to do it. Companies Act 2006 says you must produce a set of financial statements in accordance with generally accepted accounting practice. Management accounting wise, do whatever you want. So you can do whatever you need to do to give management the right information to make the right decisions to give me a competitive edge. That's the only thing I'm interested in. I just want you to make sure I'm going to get some sort of competitive edge. That's the only thing I'm interested in. That management information will never be 100% correct. It will never be absolutely perfect. It is always an approximation of what we think will potentially happen. And that approximation now means that I can't audit it. I will look at it from an auditing perspective to review what actually happens and what I thought was going to happen, which means that things such as budgets are included within management accounting. But I can't actually say, yes, these things are going to be reasonably okay. I can't give you a level of comfort here. It's very difficult for me to look at this. From a financial accounting perspective, we want things to be correct as much as we possibly can. However, with regard to management accounting, I need to be able to make a decision before the competition and then implement that decision to give me a competitive edge. That means time is more important to me. So I want the information here quickly, even though it may be less accurate. Whereas with financial accounting, I'm prepared to take an extra couple of months to make sure everything is reasonably okay. I'm not going to say bang on correct, but reasonably okay. Management accounting will look at whatever area of the business you need to make a decision on. So management accounting looks at whatever area of the business you need to be looking at. The financial accounting standards looks at the entire company. We've even got that separate entity concept, but you don't have that within management accounting. Management accounting is optional and you can do it in any which way you want. There's no rules at all. You can just dump it all onto a spreadsheet. You can have a really sophisticated management accounting package. Do whatever you want. Financial accounting, you've got to comply with standards, whether they be UK standards or international standards. Makes no odds to me. And the big issue, the big difference here is financial accounting is historic, it's out of date, it's not useful when it comes to decision making. Management accounting is bang up to date. It is absolutely 100% current to such an extent that it's probably going to give you information into the future as well. So we try to predict what's going to happen in the future. Management accounting will be prepared whenever you need to make a decision, not just this annual set of financials. So whenever you need to do it, draft it up, put something together, make a decision. Financial accounting is used by external stakeholder groups. Management accounting is used by management, full stop, just by management. Now that's really important to me. So it's just used by management. Now, there are some specific terms that you need to have an awareness of, and there's a bit of a theoretical understanding that you need to have as well within this chapter. So I'm going to spin off a little bit every now and again when we start coming to certain slides to give you a better understanding of what the issues are. If you get a good understanding from this chapter, it'll stand you in good stead for the entire whole of the syllabus. And it also allows you to carry on into your financial management paper in year 2 as well without any type of issue whatsoever. So, what we're looking at to start with, cost accounting. Cost accounting is all about collecting data usually on production activities. And what we're going to do is we're going to try and find a way to look at an activity. We're going to have a look at a way of trying to determine what a cost is. We're going to look at what a unit is, and we're going to try and work out how those costs are derived. And we're going to look at how those costs can then be driven into those units of production. So what we're looking to do at the moment is we're trying to produce information from this data. So we're going to try and produce information from this data, and that information will then be used by management. Now, management of all levels will be using this information. So if you've completed your BTF paper, you'll have an understanding of the idea of strategic, tactical and operational management having different time horizons for their decisions. So there's different time horizons. Management accounting has got to be able to prepare information for all levels of management. So management accounting systems that we have in place must be able to produce information for every single different level of manager. That is absolutely critical. Now, we need to have an understanding of the decision-making time horizon of these managers. We also need to have an understanding of the areas that these managers can then make decisions over. So what I need to do is consider what type of decisions the manager can make, what type of activities the manager can now influence, what type of level of control and authority does the manager have. that will now determine what type of information I need to give that manager to make sure they can make the right, good quality decisions. So that now allows me to work out what information the manager needs. And it's really important that I only give them the information that they need to make their decision. If I give them too much information, then the core message will get lost in too much noise. And it's that idea of noise detracting from the amount of information that we produce. As a for instance, if you're trying to make sales to somebody in a certain region of the country, you could say that every single person you're going to sell to will be in the phone book. If I gave you the phone book as the director of sales and said, hey, there you go, that's who you need to market everything to, that is completely useless to you. However, if I came back to you and I said, we've got a demographic, which is the vast majority of our customers will be female in the age group of 25 to 30 and they will live in this geographic region, suddenly that's really useful to you. So too much information can potentially detract from the key message. So we have to be very, very careful with the type of decisions the managers are making and what type of information do they need to make sure that they can actually make that type of decision. To make sure we have a better understanding of this, we have some key definitions. And some of these definitions will include things such as a cost object. And you need, I'm afraid, guys, to learn these definitions parrot fashion. I've seen these things come up in the exam fairly frequently. So a cost object is anything we want to find a cost for. So you can have a unit of product, you can have an activity potentially, you could have a project, you could have a department, you could have a geographic location if you wanted to. So a cost object is anything where we effectively can collect costs and try to find out how much it costs for something. A cost unit is different to this. So the cost object is anything where we can collect costs. So the cost object is anything where we can collect costs. So a cost object is anything where we want to find a cost. A cost unit is the actual product or service that we provide. So a cost unit is the product or service that we provide. For instance, cars, audits, chargeable hours, anything along those lines. A cost unit is automatically a cost object. So a cost unit is automatically a cost object. A cost object is not automatically a cost unit. So a cost object is not automatically a cost unit. Now that's very important to me, because this will now allow me to have a look at some questions to say which one of these things are cost units, which ones of these things are cost objects. And what you will find is this is where the question will come up. So this is where the question will come up. What we also have as an extension to these cost units is what we call composite cost units. And a composite cost unit is where you have multiple component parts making up my cost unit. So you have multiple component parts making up my cost unit. So it's composite because there's more than one. So it's composite because there's more than one. Cost per patient day, meals, that how much they cost per patron who turns up to our restaurant, those type of things can potentially be my cost units. So the cost units are things that I'm actually going to produce. They are things I'm actually going to deliver to my clients. This is really how I generated my income. This is the core reason behind my business. If you've got a service-based organization, same thing will work. So a service-based organization, a lot of you will be working in the audit sector, then audits would potentially be a cost unit. The number of chargeable hours that you produce, that would potentially be a cost unit as well. These cost units, so these cost units, more so if it's a tangible product that we're producing, but these cost units will now have to be valued by the financial accountant to allow me to measure the value of my inventory or my stock. What this will also do is, if this is the thing I'm trying to sell, so if I'm trying to sell a book as a for instance, and there's pages in it and there's writing on the pages, what that now does is it allows me to work out how much does it cost me to produce the book, and once I've produced the book, then I can start thinking about what price should I charge. So the identification of the cost unit itself will then allow for management decisions such as pricing decisions. So it allows for management decisions such as pricing decisions, and that can be really important to me. Stock valuation issues are something which are really, really significant, not just to the management accountant, but also to the financial accountant. Because if you've got a cost unit And even if it's a service-based organisation, if you're partway through an audit, you may be looking at things such as work in progress. You need to work out the number of chargeable hours that have gone into that work to determine the value of that partially completed service. Now, what we're looking at from a management accounting perspective is the answer to various different types of questions. And management accounting will give you the answers to these various different questions, which will include things such as, how much does it cost me to do something? So how much does it cost me to do something? What type of revenues am I going to generate after I've sold that thing? What type of pricing strategy should I have? Stock valuation issues. We're going to look at this in a lot of detail within this syllabus. Future costs of goods and services can be absolutely incredibly important here as well. And then an evaluation of performance, which is the difference between actual costs compared to original expected budgeted costs. That now allows me to get into what we call variance analysis, which is another key area of this syllabus. Now, in these various different papers that we're going through online, there will be various different worked examples. There'll be various different interactive questions. In some papers, we don't use the worked examples or the interactive questions at all. For instance, within the law paper, we don't use them whatsoever. We actually go through the real life cases. Within assurance, we don't tend to use them very much either because we tell you all the issues you need to know about. Management accounting involves an awful lot of number crunching. So what you will find is we will do an awful lot more of the interactive questions and the worked examples actually together online. And every now and again, what I will do is I'll jump into a spreadsheet and actually show you how to approach the question. So it's not just reading through the worked example, it's actually showing you how to do it. With interactive question number 1, which just looks at us trying to identify cost units, it's very much a yes, it's this one, or no, it's not that one. So let's have a look at interactive question number 1 and we'll just read it through together. Identify which of the following cost objects would be suitable cost units for a hotel. So what are the type of things that we're trying to produce or actually deliver as a service? Tick the boxes to indicate which would be suitable. A bar. You're not actually selling the bar. You're selling something within the bar. So the bar is a cost object, but not a cost unit. So it's not a bar. The restaurant, same sort of idea. You're actually delivering something within the restaurant. The restaurant as a department is not a cost unit, but it will be a cost object. Room per night, that is very specifically the type of thing we're trying to sell. So this is the type of service we're looking to deliver. So that'd be a big yes. Meals served, then yeah, that's the type of thing that we're trying to deliver as well. It's more tangible than a room per night, but it's still a cost unit. So yes, meals served, definitely. Conference delegate. Well, we are actually trying to service a conference delegate. Therefore, that would be seen as a good cost unit. So the conference delegate as a service, yes, that's a good cost unit. Fitness suite, no, that's a composite of everything. So there'll be extra cost, there'll be revenues, there'll be various other different bits and pieces in there. Conference room per day, yes, I'm happy with that. Conference room per day actually makes an awful lot of sense to me. Now, when we're looking at the various different types of information that we can potentially have, we have this wonderful mnemonic, which is accurate. All of these different things show different component parts of information which can be useful to managers when they're trying to make decisions. So all of these things show different characteristics of information that can be useful to our managers. The problem I've got with this is it's impossible to have all of them together. So it's impossible to have all of them together. You cannot have accurate information which is timely and cost effective. If you want something which is absolutely accurate and timely, you have to spend lots of money on it. That can cause me some issues. Now, the system that's going to produce this effective management information will come from our cost accounting system. And the cost accounting system will allow for much better quality in terms of decision making. So it allows for better quality in terms of decision making. That will now allow for competitive advantage. That then means that we can get better profits. It assists in development and control. Control is all about comparing actual results to expected results and then taking what we call corrective action. So control will result in a decision that will make things better in the future. That's where the value comes from, control aspects. The The evaluation of impact of different policies on our business can be very important as well as a performance evaluation technique. How well have we performed compared to how well we thought we should have performed, and how well the rest of our industrial sector has performed as well. That can be absolutely critical. What we do within these types of cost accounting systems is we have collection points for costs. We call these things cost centers. So these are collection points for costs. And these types of collection points for costs can be absolutely anything you want. As long as you can separate it out, then it's fine. One of the most important cost centers you'll ever come across is actually an individual who makes decisions. That person who makes decisions, will have an impact on future results. Their decisions need to be evaluated. So the manager who makes a decision, can be a cost center. That's really important to me, which now means I can evaluate their performance. We're going to come to performance evaluation a bit later on within this syllabus and other papers as well. When we're looking at these types of costs, we've got them collected within cost centers. What I need to be able to do is try to identify the behavior of costs, because if I can identify the behavior of costs based on things such as past decisions of how much units should I produce, so based on past decisions such as what should be my quantity or my level of output or my level of production, if I can identify a relationship between costs and production levels, that now means that I can predict future costs based on my future decision with regard to production levels. What this now means is we will split our costs down into direct costs and then indirect costs. Direct costs are costs that can be directly attributed to a cost center or to a specific cost unit. And what I'm thinking about now is if I'm producing a textbook, I can have an amount of paper. That paper within the textbook will be a raw material. That will be a direct material cost of producing the textbook. It's a direct material cost of producing the textbook. We call these things direct costs because they can be directly attributed to a specific unit of output. Also, direct costs will vary directly in proportion to levels of output. So if it's cost me £5 to produce this book, because it's cost £5 worth of paper, if I produce 3 books, it's going to cost me 3 lots of £5. So the amount of my total costs will increase in direct proportion to my levels of production. So if my production goes up, my costs will go up. We've got direct materials. You've also got direct labour costs, because it may take half an hour to stitch the book together or glue the book together, and the labour cost will have a cost per hour multiplied by 30 minutes will give me a cost of labour hours to actually put this thing together. That will be a direct labour cost. There are also direct other costs, which will be other variable costs. Notice I've slipped into variable costs now. So these will be variable costs, which will vary directly in proportion to the level of production. So they will vary directly in proportion to the level of production. My prime cost is direct raw materials plus direct labour plus direct other. It's total direct costs. Prime cost is total direct costs. Indirect costs, also known as period costs to some extent. So you've also got indirect costs. Indirect costs do not vary if I change my levels of production. For instance, if I've got a factory and I have to rent the factory out at £100,000 per annum, that now means that regardless of my level of production, my factory's rent will be £100,000 per annum. That's it. It does not change. We call them indirect costs because they will not vary. So if I increase or decrease levels of activity, indirect costs will not change. What we can also do is we can split these costs down into production costs and then also period costs. So production cost will include everything that we have to incur cost-wise to produce all of my units. Production overheads can include all of your prime costs. So it'll include all of your prime costs plus any additional production overheads which are indirect but still down to production, such as renting the factory that I'm going to use as my production centre. So renting the factory would be an indirect cost, but it's still a production cost. Then what we also have is period costs. A period cost is an expense that you've incurred due to a period of trading. So a period cost is an expense that you've incurred due to a period of trading. And then we also have non-production costs. And non-production costs are costs which have to be incurred to allow us to continue to trade, so they have to be incurred to allow us to continue to trade, but they are not linked to anything to do with production. What this now means is we have to consider inventory valuation. From an inventory valuation perspective, what we now need to include within any type of finished inventory and also work in progress, you need to include all direct and indirect production costs. So we need to include all direct and indirect production costs within our inventory valuation. You cannot include non-production costs. So you cannot include non-production costs. Now, cross-reference this through to a later chapter when we start looking at the difference between marginal costing and absorption costing. And all of this will suddenly come back, and I'm afraid, guys, it's going to haunt you because it's a really important aspect, which is why we've got an entire chapter on it. I've talked about prime costs. Prime costs are the total of all of our direct overheads. And what we've got is direct labour, direct materials, direct other or direct expenses. We have our total production costs, and our total production costs will include our prime cost, and these prime costs will vary directly in proportion to levels of activity. So these prime costs will now also be described as variable costs. So these direct costs are variable costs. So direct costs are variable costs. What we also have is these indirect production overheads. These indirect production overheads will not change, such as my factory rent. So they'll not change because I've increased or decreased my levels of activity, but they are still a production cost. These become fixed costs. So these things become fixed costs. And what's going to happen is they will be fixed for a period. So these indirect production overheads will be called fixed costs. And what this now allows me to do is think about these other types of costs, which are period costs, which will be non-production costs. So period costs now become non-production costs. Admin costs, HR costs, anything along those lines. Any type of central HQ which incurs costs, they will be included within these period costs. Okay, I understand how this sort of works, hopefully. Now what we need to do is put together some graphs to illustrate what this now means. And one of the things I'm going to ask you to do here, guys, is I want you to focus very, very, very heavily on the labels of the axes. Now, when I look at any type of graph, what I've got is my y-axis, which is the vertical line. We've then got my x-axis, which is the horizontal line. In all of these suite of graphs we're going to look at in this part of the course, I'm going to say that my y-axis is going to be total cost. My x-axis is my activity level or my quantity of output. If you have a graph where we can look at past levels of activity, past actual costs, we can plot that graph and try to identify the behaviour of the cost. If we know what the behaviour of the cost has been in the past, we can then estimate what it will be in the future. If you have got something such as the rent on your factory, it hasn't changed over the last number of years, regardless of the level of output, you now know that regardless of your level of output, you will have that type of fixed cost. It will not change. So you'll have that fixed cost. It is not going to change. The next type of cost we look at is a variable cost. And with a variable cost, what happens is, notice this goes through the origin where the x and y axes cross. If you have zero output, so zero activity, you incur zero cost. So zero output means zero cost. What this also shows is a straight line relationship, which means that the more you produce, the greater your cost. So the more you produce, the greater your cost. Then what we have is a fixed cost plus a variable cost added together. So you have a fixed cost plus a variable cost added together. This gives me what's known as a semi-variable cost. This is a variable cost because we've got this sloping line, but it's fixed as well because it starts part way up my y-axis where the cost is. So if I have a zero activity, zero quantity of output, I still incur a level of cost. An example of this would be an electricity bill or a telephone bill where you have a standing charge plus a usage charge. So you'd have a standing charge plus a usage charge. Next type of cost behavior we have, well, it looks like a step. So we call it stepped cost. And this type of stepped cost means that you have a fixed level of costs over a certain quantity of output. As a for instance, if you had to rent a machine to produce 10,000 units of output, the cost of that machine might be £2,000. If you produce 1 unit more, you now need to hire a second machine. But you can now increase your levels of activity by a factor of 2. And every time you go above that maximum level of activity, you have to hire another machine. So these stepped fixed costs are constant over a finite range, but they increase dramatically at a specific point. So they will increase dramatically at a very specific point. Next, what we have is a reducing variable cost. It's a variable cost because it's going to go through the origin. So it's a variable cost because it goes through the origin where the x and the y-axis both meet. So the x and the y-axis meet. That now gives me a variable cost which is based on the steepness of the slope. The steeper the slope, the greater the cost per unit. So the steeper the slope, the greater, so the steeper the slope, the greater the direct cost per unit. And what this shows you is a direct cost per unit which is quite high up until you hit a certain level of output. After that, we then reduce the variable costs. This might come about because you hit a bulk discount level, but the bulk discount would only apply to future purchases, not to past purchases. What we then have is a reducing variable, and with this reducing variable, it's still a variable cost because it's still going through the origin. It goes up in a straight line. So as we include additional levels of activity, we then incur additional levels of cost. So maybe we're purchasing more materials to make our output. However, once we hit a certain level of output and we've got a certain level of materials that we've purchased, we then get a bulk discount which is applicable to all of our purchases. And this is why the second part of the line drops down really dramatically. So the second part of the line drops down really dramatically, and the second part of the line is not as steep as the first part. So it drops down dramatically to show the bulk discount on everything we've already purchased, and it also has a less steep line after we get the bulk discount. So what we're going to do now is we're going to jump into the spreadsheet. And when we jump into the spreadsheet, you tend to find that I'll spin off a little bit and I'll do some extra little bits and pieces. So we'll jump into the spreadsheet now. And what we've got is I've got 3 graphs already drafted up, so I can just play around with stuff a little bit more easily. What I've done is I've got my x-axis still labelled as total activity, so still quantity of production. My y-axis is now cost per unit. It is not total cost. Now if I put in a slope into this, which is just going to be a line, if I show this line here, that line there now, that line actually shows a variable cost. And that is a variable cost because regardless of the quantity of production, my cost per unit, my direct cost per unit does not change. So my direct cost per unit does not change. If I was to look at something such as a fixed cost, what this now means is with a fixed cost, and this gets a little bit more scruffy, I'm afraid, with regard to the way I'm going to draft this up. So what happens is my quantity of production is low. That now means that my cost per unit is really high. As I produce more units and I can divide my fixed cost by more and more units, I now generate this type of slope. So there we have that type of slope, which will be a fixed cost. You can see where these exam questions are going to come from now, can't you? If I now added these two things together and I look at total cost, what now happens is total cost will look something like this. So total cost, it still starts quite high, but when it starts to slope down, it slopes away like that. And what you'll notice here, guys, is with the total fixed cost there, it's quite a steep slope. With this, it's a much lower gradient. It doesn't slope away quite as heavily. It takes a little bit longer to get further lower down. So there's the big differences. And what that now means is we can have a look at certain other questions. We can jump back into the PowerPoint. There we go. And what we're going to do next is we're going to have a look at interactive question number 2 to try to understand whether or not these different costs are fixed cost or variable cost or semi-variable costs. Now, what I would suggest you do, guys, is if you have a look at interactive question number 2 for me first, please, have a little read through it. And what we've got is tick the appropriate box for each different type of cost. Is it fixed? Is it variable? Is it semi-variable? We've got a telephone bill. Well, a telephone bill has got a fixed element, which is the standing charge, plus a usage element, which means it's got a fixed element and a variable element, so we call that semi-variable. So that'd be semi-variable. The annual salary of the chief accountant, well, that will not change regardless of the levels of activity. So that does not change regardless of the levels of activity. Therefore, that becomes a fixed cost. Cost of materials used to pack 20 units of product X into a box. Well, the cost of materials will be exactly the same no matter how many times we do it. Therefore, that becomes a fully variable cost. So that'll become a fully variable cost. Now, these different types of cost behaviours can be used to allow me to understand how costs will operate over a specific level of activity. So this allows me to see how these things will work over a specific level of activity. This level of activity is known as the relevant range. So if I'm looking at trying to estimate costs over the relevant range, I can do it with an element of comfort that I think it's going to be reasonably accurate. If I was to try and estimate it outside of that range, my level of comfort will diminish. It will become much lower. So I'm not as comfortable estimating costs outside of that relevant range. Now, this relevant range will be expressed in terms of activity or quantity of production or levels of production. It's expressed in terms of the x-axis. So think about your graphs again. This is expressed in terms of the x-axis, not the y-axis, only ever the x-axis. And what we have is a couple of interactive questions. Interactive question number 3, looking at activity levels. In general, as activity levels rise within a relevant range, the variable cost per unit will stay the same. So the variable cost per unit will stay the same. The fixed cost per unit will fall. And think about those graphs we've just had a look at on the spreadsheet. And the total cost per unit will fall because total cost is variable cost plus fixed cost. What this also now allows me to do is have a look at interactive question number 4. And what I would like you to do, please, guys, is have a look at interactive question number 4 and have a think about it. And what we're going to do is we're going to jump into the spreadsheet to start with. So what I've done on my spreadsheet is I've cheated a bit to speed things up. I've got total cost on my y-axis, notice this is total cost, and then quantity of production on my x-axis. And it says match the sketches 1 to 4 below to the listed items of expense. In each case, the vertical axis relates to total cost, so there's our total cost, and the horizontal axis to activity, and there's our activity quantity of production. Each graph may be used more than once. So we have an electricity bill, a standing charge for each period plus a charge for each unit of electricity consumed. Now, what does that actually mean? Well, what it means is I have a standing charge, which means it starts higher up the total cost axis, so higher up my y-axis, and then there'll be a charge for each unit consumed, which means it goes up in a straight line. You can see that that is a semi-variable cost. So that is a semi-variable cost, and that comes out as graph number 1. If I look at supervisory labour is paid as a monthly salary. That now means that regardless of the levels of production, so regardless of the level of production, we now have a situation whereby I pay the same amount of supervisory labour. That now means it's a fixed cost, and that becomes graph number 4. And notice how I'm working my way through what the words say to identify what the cost is. In C, sales commission, which amounts to 2% of sales revenue. Well, if you have this type of situation with regard to sales revenue, if we were to make no sales, we end up having 0 costs. So if I have no sales, I make 0 costs. If I'm now looking at increasing my levels of sales, I will then have to increase my costs. So the activity now becomes sales, so it'll be quantity of not production, that now becomes sales. That now means that my commission here will be a variable cost. So my commission here will be a variable cost. And that will be graph number 2. Then we've got machine rental of a single item of equipment. The rental agreement is that £10 should be paid for every machine hour worked, subject to a maximum monthly charge of 480. So I'm now looking at quantity of output, so it's production again. And what it says is £10 paid for every machine hour worked. So I've got this idea of a variable cost to start with. However, once we get to a certain point, there's a maximum monthly charge of £480, which means that once I get to £480, it then becomes capped and it doesn't go up anymore, which means I'm looking at graph number D for 3. So graph number 3 for D. And we can do something similar for E as well. Photocopier rental costs. The rental agreement is that £80 is paid each month plus 1 pence per photocopy taken. What that now means is we've got a fixed charge, which is going to be £80 per month, and then a cost per usage, which means that we end up with a semi-variable cost. And E will be another example of graph number 1. So that becomes an example of graph number 1. Now, hopefully that makes sense. If that doesn't make sense, go back over that again, stop the recording, go back and rewind it. But going through the explanations and how we get to that can be amazingly powerful. Now, the next thing we need to look at. Responsibility and accountability has got to go hand in hand. If I have a manager who is responsible for making a decision, he must be accountable for the impact of that decision. So if somebody is responsible for making a decision, they must be accountable for what actually happens, the impact of that decision. We call that responsibility accounting. And responsibility accounting will then allow for performance evaluation to be determined. So we can look at performance evaluation to be determined. And this now allows me to use, instead of cost centers, we can use responsibility centers. And these responsibility centers will allow me to understand who's made a decision, why they've made a decision, and then the impact of that decision. So is it a good idea or is it a bad idea? If it's a good idea, well done, pat on the back, here's potentially your bonus. And by the way, you're a really good quality manager. If it's a bad idea, maybe there's a training issue. Maybe I need to train that person up a little bit more to have a better understanding of what's going on. Now, no paper would be perfect without looking at ethics. And we've got our ICAEW fundamental principles, 5 of them. You've covered these in every single paper so far. Make sure you understand what these 5 different things actually mean. And what I'm now thinking about is, how can they have an impact on management accounting and the information that we produce? The way that you produce information has got to be unbiased, so it must be objective. The way that you present that information has to be done in such a way that it allows the manager with the correct level of authority to make the right decision. The way that you present the information can influence decision makers. You need to make sure that we don't do that. We need to make sure that we present it in such a way that they understand exactly what they're doing and why they're doing it. Then their performance can be properly evaluated. Now that brings me up to the end of chapter number 1. It's a critical chapter. Do please make sure you're happy with everything that we've covered. Do have a go at the questions at the end of the chapter, and I'll see you all bright-eyed and bushy-tailed on chapter number 2 very soon.